All right, everything looking good. Should be live. Somebody could just let me know in the comments. As always, I would greatly appreciate it. But looking good on my end. What's going on, Calma Betty? It says Bitcoin to 10K. Well, we're halfway there now. Parag, good to see you, buddy. All right, so obviously got a nice stream today, but let's go ahead and get it started with the intro. Welcome back to the channel, Crypto Trend Trader, with our midweek market update. It is 8 p.m. Eastern Standard Time on 6/15/2022. Before we get started, I would like to remind you, it's not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and, of course, trade responsibly. Appreciate it, Yoda. Thank you. Sotos, good to see you, brother. All right, so obviously the, big day came and went today. In case you are not familiar, which I'm sure all of you are, we had the, 2-day Fed meeting, and then Fed Chairman Powell came out and spoke. They did decide to go with 75 basis points. Prior to that, they had said 50 basis points, and 75 wasn't even on the table. They did come out, though, on Monday, and they basically leaked to the press that they were looking to do 75 basis points. Still wasn't sure exactly if they were going to go with it or not, to tell you the truth. I still thought they were going to do 50, but, you guys know how I feel about the Fed and their lack of accountability. So it was good to see them go 75, obviously. But at this point in time now, we're doing things we haven't done in literally decades. So the first rate hike was 25 basis points. The second one was 50 basis points. And now we just did 75 basis points. So this one is 3 times the first one, or the combination of the first one and the second one added up. And Powell was very, very clear that he said some weird stuff, and I'm going to do a full video on this, and we'll look at the dot plot, and we'll talk about it and how it's destined to failure, because if the Fed's right, they fail, and if they're wrong, they also still fail. So we'll do a video on that, maybe just like a static video that just talks about that, and I go over everything instead of doing a live stream. But regardless, we'll get into all those details later on. But regardless, the way Powell worded it, he said, we know this is like, a big rate hike, and we don't expect to do more of these into the future unless things are bad. But then also next meeting, we're probably going to do 75 or maybe 50. So, I kind of looked at it as him saying like, hey, things are bad and we're reacting to the markets. So in my opinion, the Fed has failed completely at everything, and they're complete scumbags and shouldn't exist at all. No central banking should. But that being said, given the situation we have, I'm glad to see that they at least did 75 basis points. Now, is that going to do anything? No. I mean, we already know that, all the Fed policy acts with, a ridiculously long lag. I mean, we're talking about like 12 to 24 months, on average 18 months from when they change something to when it like truly affects markets. So the only thing that happens in the meantime is just the market, quote unquote, adjusting to price in whatever the current, bullish or bearishness or hawkish or dovishness is. So when it's all said and done, does this change anything? Not really. I think it's a step in the right direction, at least. It shows that the Fed is more concerned about doing the right thing, I guess you could say, over just making sure that the market doesn't have any surprises. And they sort of came out and did that anyway, because someone essentially like leaked out to the press on Monday that they were going to do 75 basis points. So it's like, did they really just change their mind and then adapted? Would it have had more shock if they didn't say anything and just did it? I imagine so. So I think this was their version of kind of like the middle ground. They didn't want to straight up shock the markets, so they leak it out or disclose it to reporters or whatever in advance. And they were even asked about that. And again, we'll do a breakdown of, everything that was discussed in the video. But overall, the dot plots have been adjusted. It's clear to them that inflation needs to be fought. They have the inflation. I mean, when you start looking at these numbers, when we take a look at it and we look at the Fed funds rate and what they're anticipating and all this stuff, I mean, we already know that it's a confirmation of breakout on the 210 or on the bond market, and like the 210 spread will have inverted. So we know that it's a lose-lose situation. They're either not able to fight inflation, inflation wins and gets out of control, or they fight inflation and they win and we completely crash the market and, essentially confirm a 40-year trend ending in the bond or, rate market, etc. So that being said, we'll take a look. We saw basically what we would expect. A little weakness in the Treasury, a little weakness in the DXY. Here's our TNX on the daily. And essentially, we're still at just all-time highs. We're at 3.39%. We hit, or not all-time highs, but cycle highs. We hit recently 3.48%. So, we're down a little bit, a couple basis points, nothing serious. At this point in time, though, what we're looking out for is where does this trend run out of momentum at? If this histogram runs out anywhere below this prior peak right here, we have bearish divergence. So this could easily move up here and just run. It could come back and pull back and then run. That's all fine. But if we put in a lower high right here, and then we compare that to price action, our peaks back in here versus here, we have a higher high on price action, a lower high on our indicator oscillator, and that is obviously bearish divergence. So what we'd be looking for is potential reversal. Now, if we come over to the stochastics, though, here our stochastic has actually peaked all the way back at this level. So arguably, the stochastic is not giving us that same potential bearish divergence. So, normally, like always, when we have a bunch of different indicators or, techniques that we use or tools at our disposal, we're looking for confluence. So in this case, we do not have confluence between these, so it's much less reliable. You guys know, obviously, that we're at those key levels. Oh, you know what? We haven't even, oh, this is crazy. Yeah, this is our first video since another, one of our ordeals came true. I don't even know what to say anymore. Last video, we were talking about how we were basically confirming a Treasury breakout and that we were essentially at the point where we were close to taking out the previous all-time high. And at this point in time, we've taken it out on the daily. So we switch back to a shorter time frame briefly. We actually took out that 2018 high on the daily now. And now at this point in time, the last time we've been at these levels was back in 2011. 2011. So we're tighter now, than we have been for the last 10 years, 12 years almost, 11, somewhere around there. Somewhere between 10 and 100 years since we have seen, the 10-year Treasury at these levels. So, and then paying attention to what's taking place now that we've closed essentially like daily above them, we flip over and look at the weekly. And again, it's the same type of thing. We've already closed. This weekly breakout was technically lower. So we still have until the end of the week this week to confirm a weekly breakout. So we've already broken out on the daily. All we have to do is not sell off below, 3.15 on yields in the next 2 days. And we've broken out on the weekly. And then at that point in time, obviously we will be looking at the monthly and, we still have half the month left. But again, maybe we could get a blow off top and it just leaves a wick behind him and go back down and it was just a rejection and everything goes back to normal. But then when you start looking at it and you say, okay, what's going to cause all of a sudden the Treasury yields to go down? Oh, well, it must be a Fed pivot. Well, the Fed is not going to pivot. We have barely even started our tightening cycle and we have record inflation. So basically what the Fed is saying is, hey, we're going to raise up rates and make money extremely expensive so all this capital dries up. We are going to sponge this stuff up as fast as we can, but we're going to start off slowly. But after that, it's going to be fast as hell. But we're going to start off slowly. And then on top of that, they're essentially saying, we have record low unemployment and record high inflation. So we have two mandates. Stable prices, obviously has to have priority right now, because employment's already ridiculously good. So we're not worried about employment. We're worried about stable prices. So that means they don't care about employment anymore. Matter of fact, they came out and they gave their old generic statement, which is basically just, hey, just so you know, like, it's not just white people that are doing well. Black people, Hispanic people, women, they're all doing great too. And everything's gravy. So now we're going to go ahead and just, we're going to put a little pressure on the job market, essentially, is what it comes down to. So they're going to force layoffs. They're going to force a slowing of the economy. Arguably, they're going to try to perform a soft landing to stop the recession. But we know that's not going to happen. They've already failed at that. Not indefinitely. It's still possible. But we already have 1 quarter of negative growth GDP. They've already adjusted down now. From first it was 6%, then it was 4%, then 1.8, then it was 0.6, and now they're at 0. So, so if now they're at 0, if they're off by any measure, it's negative and we've confirmed into a recession. So, we're there. We're 1 month away from the confirmation of the recession, and they're still saying we don't see any signs of recession. I'm like, really? Okay. So that being said, TNX still very, very strong here. And looking at this on the monthly, I mean, this is the beginning of, we've talked about this countless times. This is basically the beginning of, a multi-year trend to the upside. What's that mean? It means no more cheap money, no more free money. And everybody's like, no, the Fed, they're going to print again. They're going to do this. All right, I guess we'll wait and see. I guess we will wait and see. So TLT obviously going to have the negative, the inverse effect. So it was down here at the lows, kind of popped back up a tiny bit. But, we've been talking about this, and it has broken down from key levels. And, we broke down from our descending channel and our ascending channel. And when we pushed back up, we got rejected by the descending channel, couldn't hold above the ascending channel. So at this point in time, we have broke down from a clear, massive, channel going back, as far as this chart goes back. And at this point in time, we have broken down from a head and shoulders. We have broken down from our green ascending support. We have broken down from the blue channel support. The only thing left at this point in time is free fall, in my opinion. And that corresponds perfectly with the bonds basically breaking out. And, the predicted Fed funds rate and the dot plot and all that good, juicy stuff that, apparently people don't understand how it works or they're in denial. I don't know. So next we have the VIX. So obviously we talked about this VIX move. We called the bottom perfectly. That actually amounted to a massive move in crypto. We'll get into that in a minute. But, we were at 30K not too long ago, and your boy was calling for 20K. And, where'd we go to? 20K. So we got it. We did it. At this point in time, though, I do think somewhere around this area, we see a dead cat bounce, some kind of reaction rally, a counter trend trade. We currently have some trades on in the group. Ethereum and Bitcoin as well. Short-term scalps for now, just to see, because we don't know where this is going to go, but obviously taking advantage of opportunities as they present themselves. That being said, the VIX shot up here in basically like 3 days after perfectly calling the bottom right there, and then we topped out at the heart line. So as far as I'm concerned for now, we're just chilling out for a little bit. We're consolidating, but I do expect sometime in the very near future for us to take out this high right here. So we can see there's kind of like a little bit of a resistance building, depending how you want to kind of look at it. Something along these lines right here. We have, depending on, here we have like a wick touch, here a little wick, and then a little wick action right there. This one, arguably, if we pull it down a little bit, we got a little touch. So that's going to be our resistance. We now have a descending resistance line. We have the ascending resistance from the heart line of the channel. And, essentially it'd take a little bit to get through there. But once we do, at that point in time, we would expect to move towards the top of the channel. So if we go from the heart line of the channel, which is where we're at right now, up to the top of the channel, let's just say we did it tomorrow, we're going to be basically somewhere around like 48 on the VIX. But in all reality, if we pop up to the top of the channel anytime from here on, we're up in that 43/44 zone. And that's where we look for the long time tops at. So this is juicy. Now, it doesn't have to happen right away. It could be over days, weeks, months, but that's where it gets juicy. That's where we get, real legitimate buying opportunities. And we don't know what's going to happen right here. We could easily burst up in there. It could look like a buying opportunity as markets just capitulate. And then we could see it push back down and then burst up again and put in a lower high. Everyone's expecting a higher high. We capitulate a second time and we actually put in bearish divergence on the VIX, which then tells us that the market's going to shoot to the upside. But that could happen over the next couple months. It could happen over the next couple years. It might never happen. But what we're seeing right now is, what the potential setups are going into the future. And now in hindsight, after talking about this in advance and discussing what the VIX was basically telling us, as we had this channel right here, and then we literally got a buy signal, hard buy, left the bullish control zone, bottom of the channel, shot to the top, hard buy, left the bullish control zone, bottom of the channel, shot to the top. Here we had left the bullish control zone and we got the hard buy. Not as close to each other as we would normally like, but that's okay. Still viable, just less reliable. And again, shot up straight to the top of the channel. Here, exact same thing again, up to a lower high this time, and then here from the bottom. So, obviously, when you're trading with the trend, and then we print in, and in this case, we have a bullish trend, and then we're printing a bearish signal, bearish control zone, and then the hard buy coming out of it. So we're leaving a bearish area where the bears were in control and the bulls are taking over. We're leaving the bearish and bulls are taking over. Leaving the bearish, bulls are taking over. Leaving the bearish, bulls are taking over. And again, this move has only just begun. So we'll see where it goes up to. We're at multiple resistance here, but I do expect it to burst to the upside. We'll run into obviously some serious resistance once we get towards the top of that range there. But keep in mind, the VIX is meant to oscillate inside of a range. It's not supposed to just trend up like a stock or, you know, a decent crypto or something like that is. So we do expect eventually it comes back down, but these periods can last for extended time. This was obviously the, you know, spike high from Rona, and then we consolidated downwards for, you know, essentially years after that. And now here we are consolidating to the upside. So it's not unrealistic to think we could have a spike high and then a similar situation happen. Or maybe something changes and we have a spike down back to the normal, like more neutral area. But the VIX obviously giving us that picture, doing its job perfectly. And keep in mind, if you're not looking at the VIX, if you're not looking at the gold silver ratio, if you're not looking at, you know, Bitcoin dominance, you're missing out on a very, very important information. All right, so next, Dow Jones. So we essentially had some aggressive sell-offs. We came back down to our target, a new low. So we're putting in new lows. And then today, obviously, opened up okay, trended down a little bit, trended back up a little bit, sold back off neutral. So we're in a bearish trend. We have a neutral daily candle after putting in a brand new low yesterday. Hard sell signal. You know, all of our indicator oscillators trending to the downside. You know, we've already penetrated 236. Next area we're paying attention to on the Dow is just a pre-Rona dump. I mean, this is February 2020. That's our next support level. It lines up also with some other key levels. You know, nothing too crazy, but we have a couple touch points down here for the bottom of our little descending broadening wedge. We have a couple random touch points here from way back when that mattered. May matter again. I mean, it's worth just having them there, but they all kind of line up in the same area at our blue box area, also at the top from the pre-Rona dump. And then slightly below that, you know, and that is at 29,495. So 29.5. Slightly below that is our 382. So we're paying attention to the 382 level as well at 28,237. So last time we had one of these, you know, meetings, we saw immediately a bullish reaction rally in the markets and then essentially just bearishly engulfed and gave it back. Doesn't have to happen again like that, but I think the initial reaction was, oh, thank God they only went 0.75. They didn't go the full point. You know, they didn't go the full interest percentage. They went 75 basis points instead of 100. And I think that's the market's reaction is they were already kind of pricing in 75. They were afraid of 100 and then 75 shows up. So it wasn't as bad as it could have been. Therefore, if it's not as bad as it could have been, even though it's still bad, it's technically good. You know, as demented as that is for the market to think like that, you know, that's essentially the rationale behind it. But we're still below 200 exponential and simple. We're still putting in new lows. Still looks absolutely horrendous. So next we have SPY, S&P. So again, we broke down below the 236. So the next key levels to watch are, in this case, and remember, it's not every chart looks the same. The 382 in this case comes into effect before the pre-Rona dump, before the pre-Rona top. Okay, so we have those two levels lining up. The 382 slightly higher at 354. The pre-Rona top at 339. Those are our next targets at downside. Again, we're paying attention to just a series of lower highs and lower lows. We could put a little something together on the bottom for some kind of support here. It's not beautiful, but I think it's at least, you know, worth paying attention to. We have essentially like 1, 2, 3, 4, you know, and then another like 3. We'll count it as 1 touches right here. So we have like 4 or 5 touches on that same area. So it's worth paying attention to. It's not like super clear cut, you know, beautiful support area. But again, it's worth noting we are at the bottom of that support area, but it is trending down. So if we just go sideways and then we just come back down to support again, we're just consistently putting in lower lows. And then obviously if we look at the top of the range here as well, you know, we have a resistance where we touched previously, one here, and that would be the top of the range, which would essentially be what we expect at some point in time. We expect a retest of the top of the range. We expect a retest of key Fibonacci levels, of the heart line of the channel, of the 200 exponential and simple. So, you know, we just don't know when it's going to happen. So we're looking for like bullish divergence signs from key support and levels of exhaustion on the market for when we can enter into those short scalp plays so that we can take care of that movement to the upside or unload positions, you know, or enter shorts at those levels. So that being said, we've got pretty clear targets on the S&P. Again, consistently putting in lower highs and lower lows, clearly below the 200 exponential and simple. No doubt whatsoever, we are in a bear market. There's no reason to be quote unquote buying dips indiscriminately. Now, if you have a trade setup, that's different. If you're making a scalp, that's different. But if you're just buying dips to hodl, it's all about your time frame, because you need to have, a multi-year time frame. Right now, to be buying the dips, if you're just planning on hodling, in my opinion, right now, like for me, if I was just going to hodl a position, I would not buy a position indiscriminately unless I was expecting to be holding that position for a minimum of 3 to 5 years. And the reason for that is we don't know how nasty this is going to get yet. So if it's just a regular bear market, sure, maybe it's almost over. If it's a, little more aggressive or shallow bear market, I should say, maybe it's almost over. If it's a typical bear market, we probably still have, 10% more to go. If it's a bad bear market, we could see 20 or 30% down. If it's, Great Recession or, GFC 2008 or, dot-com bubble burst, we could easily see, massive, massive downside potential. So the most important thing right now is protecting ourselves from downside, because we're in a trend to the downside. And then we don't have to get the absolute best prices on everything. If we're buying them lower as the trend starts to reverse back to the upside and we start to see signs of life and start trending back bullishly, then we may get a worse entry price. So we may pay more for the assets we want, but we have a substantially higher probability of those assets trending to the upside rather than having further downside. So sure, you can buy the dips, but you don't know if the dip's going to go another 50% down or 75% down or whatever. But once you start buying into the uptrend, it's the same as kind of shorting into the downtrend. You're trading with the trend. So we're not going to get tired of trying to fight the trend all the time. Instead, we're just letting the trend do all the work, and then we're just kind of popping in, popping out, kind of adjusting positions accordingly, rebalancing, etc. So that's the most important thing, in my opinion. Obviously, here on the NASDAQ, so we broke down, we hit the 382. So again, obviously deeper, retracement so far than we've seen on the SPY or the Dow Jones. But at this point in time, we bounced up, we got rejected, we're coming down. We're almost to the 0.5, which is 10,000, about 400. And then after that, we have the pre-Rona peak right here, depending on what time frame you're in, somewhere around like $9,866.24 roughly, and 24 cents. But yeah, somewhere around that area. So we've already hit a key support area, at the 382. And then, next target to downside is going to be that 0.5. If we do start to see some strength in the markets, we can start paying attention to like a potential bounce or something like that. But one day and some like trash stocks that are down like 90%, I'm not like, oh my God, this is it, the bottom's in. We've seen that over and over again, and we've seen how it played out. I mean, look how many of these, talking head, influencer, mainstream fools have come out and said, this is the bottom, it's over, it's done, we already hit bottom. Think about all these clowns. Zero credibility, because they're always wrong. That being said, let's take a look at the Russell next. So Russell, again, selling off violently, well below 200 exponential and simple, seeing no strength out of this whatsoever. We are now officially touching that pre-Rona dump in 2020. And we are actually below the 2018 highs. So if you bought in the Russell at the peak of September 2018 and you just held from then till now, essentially you just spent 3.5 years roughly, and you've earned nothing. Right back at those levels. So this thing has literally round trip completely. So, obviously we had a aggressive sell-off prior to the round trip, but we're right back where we started. So, we have like 10 trillion more in currency floating around in the world, 5,000 more on the, trillion, 5,000. Yeah, sorry about that. We have 5 trillion more on the Fed's balance sheet. We're at record numbers, almost $10 trillion on the balance sheet. And yet, what did they really do? All they really did was inflate these stock prices temporarily and inflate housing prices. So congratulations, you achieved nothing. You prolonged the pain. You overshot the downside so powerfully to the upside that now we're probably going to overshoot the downside, back down. So just how deep do we go? Well, we already made it to 382. We already did the full round trip. So next target to downside on the Russell is our 0.5, which is going to be at 1,544. And again, this looks extremely, extremely weak. If we lose this level right here, I mean, that is so bad. I mean, just taking out these two key levels right here is horrendous. Now, fortunately for the Russell, this thing is such trash that it consolidated basically in this range for like literally, you know, I mean, 6-7 years through here of price action. So we have plenty of support through that area, basically as we're like chopping through it. But, you know, key levels to watch are essentially, and we'll see this with like, you know, that arc chart that I have drawn up as well. You know, you see basically a pretty nice cluster of support essentially between the 618 and all the way up to that 382. So we're at the 382 now. So I do expect now, you know, the Russell obviously has looked like trash for a real long time, and it was very clearly distribution taking place. And obviously that has played out beautifully, and we're back down to key support levels. But this thing has gotten beaten down pretty badly. I'm not saying it doesn't continue to get wrecked. It definitely does because it's trash. But the moves from here on out are going to be much more difficult. And the reason I say that is when we were on the way down, we only had, you know, literally from when we broke through that previous 2018 all-time high, when we broke through that in 2020, this is November 2020. So let's just call it 2021. So, or we'll stick to that accurate. So November 2020. And then at that point in time, from when we got to the top of the channel, or the bottom of the channel was like February 2021. So literally a couple of months of price action between here and there. So now when we came back down, it still took us longer to chop through it, but we broke through all that price action. So we took out 2 months worth of price action here. Here we have, you know, when we first got into this area was going back, well, like that's what is now the 618. This is going back to like December 2016. And we chopped around in this area with the exception of a little breakdown here and the Rona dump right there, essentially till we broke out of it in November of 2020. So, you know, we basically have 4 years worth of price action right here to chop down through. So it's going to take, you know, if this took us a couple months up and, you know, 50% more on the downside. So call it 2 months to get to the upside and then 3 months to get back down through that support. If this is 4 years worth of support right here, you know, we can realistically expect some sort of similar comparison in time frame. You know, maybe it takes us a year and we get down through it aggressively if we go that low. Maybe it takes us, you know, 5 years, 6 years, who knows? But, you know, we're not talking about something that's going to happen in the next month or two. We're talking about something that happens slowly over time. Now, there is always a possibility that we get a capitulation event like this, but we'll see it coming because when we turn over to our longer time frames and we really pay attention to what's taking place right here, you know, we can watch as each of these confirmations takes place. So on the Russell, what we're paying attention to for the next confirmation is the 200 simple is flat, 200 exponential has negative slope on it. If this 200 simple flips over and confirms bearish, now it's just like when that happened on the daily. And we see what happens. You know, we immediately get the beginning of a capitulation event. We then get a retest of the 200 exponential and simple, aka the reversion of the mean play. And then if that gets rejected, we continue to, you know, chop down, see further downside. We can kind of chop down, you know, visit the bottom of the range, hit one of those other fibs, etc. But we'll see it taking place. And then obviously as we see the weekly confirming into a bear market, should that take place, which looks likely, you know, we also see the monthly confirming the 821 cross that downside. We know historically speaking that there's a large probability that when the 821 cross that downside, we will see a retest or touch of the 200 exponential and simple. Does not have to happen every time, but we know historically happens more often than not, depending on which of these we look at. But, you know, a retest of those levels would be 1,265. And then we turn the fibs back on. Realistically, the 618 is 1,380. The 786 would be the 200 exponential and simple, 1,191. And actually, it would look nasty if we got down there. It would look nasty for sure. But that being said, if we did that, we would technically confirm, you know, a higher low, and then we could just continue to the upside in this long-term, you know, bullish macro trend that we have. So how long does it take to get there? We don't know. How deep does it go? We don't know. But technically on a monthly, as long as we close our monthly candles above 1,125, the monthly will never close, like confirm into a full-on bear market. Now, if that starts to take place, then we have to really look at, you know, Great Depression type scenarios, etc. But that being said, we are at a key support right now, and it is going to be difficult for the Russell to move down through here. It does not mean it can't happen, but I think it's going to be much more of a steady grind down from here. All right, so we're going to take a look at all 11 sectors I've been kind of slacking on a lot of them lately just because they've all, pretty much looked like trash. So we've just been looking at like the safety ones basically, like real estate, utilities, and then, the big performer, energy, obviously. But we're going to go ahead and take a look at all 11 today and just kind of see where everybody's at. And, so we can kind of get a reference for how bullish or bearish each of them are. So XLI, we'll start with the industrial sector. So industrial, obviously, each of these charts is going to be drawn essentially the same way. Or, some of them we may have to make the same way, etc. But in my opinion, right now, what every single chart that we're using should have is we should have a fib from the bottom of the sell-off for the Rona dump up to the top right here. And then we should treat that essentially as, a low to high Fibonacci for an internal retracement. So this one that's currently on here was from the bottom, the top before the dump to the bottom of the dump. So then once you get back to the 1, it puts our Fibonacci extension targets in play. And the 1.236 was our support. The 1.382 was our resistance. So when we got up to those key fib levels, we saw a clear confluence between that. So we know that this is operating off of our fibs very clearly. But for now, I'm going to go ahead and delete that one because we really don't need it anymore until we start moving to the upside. So what we want to do now is just chart from the bottom of that Rona dump up to that same top right there. So instead of going from the top right here to the bottom right here to give us a target to the upside, we're going from the bottom right here to the top right here to give us internal targets back to the downside. And that's our retracement. So what we have right now is we've already made it to the 236 retracement. Our next target will be the 382. And it just so happens that if we sort of like continue on this kind of trajectory, we have this long-term ascending channel right here that's kind of trending up towards that 382. So the probability of seeing some kind of support around those areas, if we get to the 382, if we get to that, ascending support, we would expect some kind of a bullish move off of that. Now, does it just move back up and then put in a lower high? Probably, but that's what we're looking for. And when we really zoom out on the industrial sector, we can see here, basically this is just going back to 2010. If we switch to a longer time frame, we can actually see it's the 2008 low is what we're paying attention to. The 2008 low, right? 9, but after the 2008 GFC, obviously. And we've been trending inside of this channel the whole time. And like 90-something% of the time, we've been in the top portion of the channel, the top 50% of the channel. We've touched the top multiple times. So we have clear support and clear resistance in the top of the channel. And then we have, this big leg down from 2009. We have the big leg down from 2020. Both corresponded pretty clearly with the bottom of that channel. So now that we've broken from the heart line of this channel, it makes sense that we're probably going to be heading down to the bottom of the channel. And that also obviously lines up with the 382. We obviously on the monthly also have, our pre-Rona top right here as well. So we'll pay attention to that. I'm going to just put it on the wicks just because we're going to be back on the daily and it will probably look a little more reasonable. But, you can do whatever you want. Wicks, bodies, as long as you're consistent and it works, doesn't matter. But that being said, it looks very, very weak on the monthly. Hard sell, left the bullish control zone, all red histograms. We're very close to confirming that 821 cross, and obviously we're losing key levels. So very much bear trend, and we're just going to pay attention for those targets to the downside. And in this case, since we've already made it to the 236, our next target will be that pre-Rona dump at 85, and then again we'll start looking for areas around like 79. And that is XLI Industrial. So next is XLP. So we have our consumer staples. So consumer staples obviously was holding stronger for longer, but has topped out here. Came down below the 200 exponential and simple, got rejected off of it, and then see continuation of the downside. New lows. So we now have a high, a low, a lower high, and a lower low. Clearly in a downtrend. Clearly, a bear market has confirmed here as well. So we're just looking for downside targets now. And if we do that, we just do the same thing again. We'll look for some key resistance or support levels. We'll look at the pre-Rona level right here as well for the dump. And then we can go ahead and put our Fibonacci in play also. From the low to the high right here. And then we have those same targets. So again, we broke down from the 236. Next, we're looking at the 382 around 66.28 or 65. Would be those pre-Rona highs. And then we do have this little like kind of area along the way. It's not as important, but I still like that we have it on here as it was essentially this channel we were kind of topping out through. We broke above, couldn't hold, held support, broke above, couldn't hold, held the heart line. So it's clearly an important level. And that's essentially where we touch down now. So as long as we're kind of in this area, oscillating between 68.60 and 71.38, I'm actually not bearish right here. I think it's more likely we chop around for a bit. Same type of thing. It's going to take us some time to kind of work through this before we lose that support and go lower. But the more things we start to see hitting these key supports, key levels, and kind of holding, that's when we're going to start looking for like, a potentially like decent counter trend rally. Now we're not looking for it right away because we just broke down to new lows. So we would expect some sort of like bearish continuation, but then eventually we'll see that exhaustion and we want to capitalize on the move back to the upside. So that is XLP, consumer staples. So next we have XLF, financial sector. So again, it's been a while since we looked at these on stream. So I may have to clean a couple charts up. Okay, so this one we have already at the top here. So yeah, we've hit our pre-pandemic top right there and breaking down. This one has our fib already in place in white right here. So we know the next target to downside is the 382 at $30 basically. And we're already essentially at support at this level. So again, that's good. We want to see a bunch of these like assets or sectors hitting key support levels at the same time and then holding them. Here also you'll notice, just for a little confluence as well. Let me make this a little bit brighter. I always talk about confluence and how it's more important when we have a bunch of reliable things all telling us the same thing at the same time. Well, in this case, if we took our low right here, which was support after we put in like that high in 2021, and then we fib to the top of the channel right here, and then we see our, obviously the zero line is right here when we broke down past that low, but we have in place now a target to the downside, which it's tough to see because it's actually, here, I'll just delete this real quick and then we'll put it back. It's actually right here in blue, and that's our 1.618 Fibonacci extension for that move from the low right here to the high right here. And we'll notice that that's actually exactly where we bounced off of. So we hit that 1.618 target perfectly, and that's where we're actually finding support at currently. So while it looks like there's sort of like, a little nowhere, like no man's land kind of thing going on right here, it's actually the 1.618 Fibonacci, and then it also lines up perfectly with the pre-Rona high. So that's two levels of confluence, which, if you weren't looking at the pre-Rona high or you weren't looking at the 1.618, you might just think, hey, we just stopped in the middle of nowhere. That's weird. But no, that's not the case, obviously, as we can see here. And again, depending on how we draw these kind of supports here, as the price action kind of develops, as we go from, wicks or bodies, etc., we can just see that we have lower highs and lower lows. So again, still just very bearish, but at support. So we don't want to get bearish now. We want to stay bearish until there's reason not to be, though. So XLRE, real estate, again, putting in new lows. We saw like that big dip off here. We hit our target now. So we put in play this a while back now. 12% downside potential for a short with a 6.6 stop loss, essentially for a double top or lower high peak, which was basically our kind of like ugly head and shoulders pattern. When we broke down from that, we had to push back up, tested it as resistance, and then we broke down and we completed our second trade setup, which again was 6.7 stop loss with 20% downside profit. So congratulations to anyone who capitalized on that move. But now we are in fact at the 382. We have broken down from the pre-Rona levels, which was our initial little stop right here. And at this point in time, again, strong support, but we've broken down past those levels. So this is very, very weak. Real estate is very weak right now. Well, how can that be possible? The real estate sector in February of 2020 was the peak. Prices are still through the roof right now on actual like houses if you try to go buy one, and yet somehow the real estate sector is not doing well. Why is that? Well, there's a lot of other factors. The difference between commercial real estate or residential, the difference between where there's mass migrations going in versus exoduses coming out, mortgage rates. Obviously the home values can be high, but if the mortgage rates are high also, the underlying might not do as well as someone that's actually just buying a house. So, speculating does not always see the same, moves or strength in something like a ETF or something like that as the actual real estate market might see itself. Because instead of just investing in, say, a house or something like that and speculating on a house, you might be speculating in a fund that's, got rentals or commercial real estate, or maybe they picked a bad location. So there's a lot of extra factors. Home builders could be under pressure, etc. So when it's all said and done, again, we just completed a nice short to the downside. So we're not looking for an immediate move. Possibly a lot of people have been looking at the same short or participating in the same short. So possibly now, as we take profits on the short, we might see essentially like the dead cat bounce, or, whatever people want to call it, a short squeeze. But in all reality, it's really just shorts taking profit. And when they take profit on a short, you just become a buyer. You already sold at the top, and then it went down, and now you have to buy back. So when we see that bullishness kind of here at a key support level, it's not actually people buying because they're like bullish now because we hit support. It's people closing a short because they're not as bearish because we're at support. So it's the same thing, just reverse effect. Now we're in a bear trend. So instead of selling at resistance, we're buying at support. But since we're in a bear trend, we're bearish. So we're already negative. We're already, selling into the market. So then when we hit support, instead of technically buying support, like increasing our position, we're actually technically just going from net negative to flat, or sometimes net positive. But that's the differences. Once we're bearish, we're net negative. When we hit support, we might go flat. When we hit support, we might go flat. But we're not necessarily going back bullish in these moves. That's the actual move that we'll look for, the reversion of the mean play. Now that we've broken down and confirmed into a bear market, at some point in time, we'll find some support and we'll push back up and retest the 200 exponential and simple. And if it acts as resistance, then that's essentially the market saying, hey, we're now officially in a bear market. We're all selling into resistance the same way that on the way up, we were buying support, front running support, buying support, and then it breaks down, people get scared, and then it comes up here and puts in a lower high, and then people start to sell resistance. But then you buy support again, we break down from support. So as soon as we start to come back up to that level, people just want to get out of their position, break even. Here we failed to get there. All of a sudden the selling picked up and people said, uh-oh, lower highs consistently, so we're probably going to dump again. Enough people sold into it that we saw like a bloody waterfall back down to support. And that's when we hit our target. So at some point in time, whether it's now or whether it's later, we fully expect a move back to the upside to intersect with the 200 exponential and simple and confirm that we are officially bearish on these markets. Sometimes it doesn't happen. Sometimes it happens multiple times. Here, when we confirmed into a bullish market, here we technically had the 200 exponential and simple bullish for the first time. After they were both bullish right here, we moved up. We came back down, reversion to the mean play. That's the last bearish play you should ever have in the market, because the market is essentially confirmed bullish right here. So the last thing you should be doing selling wise is the reversion of the mean play. And then after that, you should be buying the dip because we're long at that point in time. Well, the same thing here. This is, we're now short on the market. So the last long we want is a long back up to resistance. But at that point in time, we want to be selling into everything. So real estate is holding up better than some things are, on the indicator oscillators, but it's also doing worse than a lot of things are on the amount of damage that's already been done. And if there's been this much damage already done on something like XLRE, a real estate fund, we can only imagine what the actual real estate market could look like going into the future if we see continuation of this trend, which seems likely at this point in time. As we get to rates, when you start paying attention to the rates and people are like, well, historically, the rates aren't that high. It's only a 6.3 mortgage rate. That's not so bad. And then you say, oh, but also, though, it has been like, 2%, 3% mortgage rate, 4% for the last, decade. So sure, it's not that bad if you look at the last 100 years of what it costs, to get a mortgage. But when you start looking at record high home prices and, decade high interest rates, all of a sudden the houses are unaffordable. The interest rates were just at 3% not long ago, and now they're over 6%. So when you start doing the math and you say, okay, I have a $2,000 mortgage payment, and then all of a sudden, somebody wants to try to buy that house from you now with a new mortgage, and it's like, oh, well, that same $2,000 payment looks more like $2,900. So anyway, XLV, healthcare. So we have here a, sort of like a double head and shoulders, something like that. We kind of underperformed on the right shoulder. That was obviously a hypothetical right shoulder. Obviously, it was like a two-headed, head and shoulders. So not the prettiest pattern right here. But again, it's not about the pattern being beautiful. It's about the psychology behind the market. We clearly ran into resistance a couple of times. We put in a new high a couple of times, but just couldn't see continuation. We came back down, retested support quite a few times. And every time we retested the support, we just could not get back above. And then eventually we broke down from that support. So broke down from support. hit the 236. Typically what happens is we get a retest of the breakdown. Now, are we going to come back up to 126? I don't know. It doesn't have to happen, but typically that's what we see. Maybe close this gap, come back up, get rejected, and then we start looking at the 382 down here at 111. And then obviously we have a little lower than that, the pre-Rona dump at about 105. So that is healthcare. And once again, all these patterns that we were calling out, identifying as various distribution patterns, here in hindsight, it's clear. It's clear. I mean, there's no doubt in anyone's mind now that there was distribution taking place. Now, the whole time we were seeing it happen, it was all reaccumulation, new all-time highs. There's going to be a melt-up. Well, these morons calling for a melt-up this whole time, where the fuck were they at when the rest of us were getting the gains from the melt-up? We melted up, and then we got up here, and then people are like, I think there's going to be a melt-up. And you're like, doo-doo-doo. I mean, what just happened? So, again, everybody else behind the curve on all this stuff. And that's the beauty of, efficient technical analysis. So next we have material sector, XLB. So we can get a good idea as to, what the actual, what the actual portions of the economy really look like when we start to break down on some of these things. And as we start looking at it, we start realizing, wait a minute, we keep hearing about how strong the economy is, how many jobs we've added, all these like bullish different things, and, everything's great and they're gravy and the consumer's strong and all this stuff. But when we look at the actual sectors and their performance, when we look at reality and like walk outside and, look at how many businesses are closed or gas prices or, supermarket shelves, we can tell that not only is this not the best economy we've ever had, but it's also the most unstable or unstable times most of us have experienced in our lives. And, a lot of this channel is, worldwide. So I don't know what other countries look like exactly, but I would imagine that overall, we're very fortunate to be in the United States. Obviously, other people want to come here or we wouldn't see like literally millions of people pouring over our border. So that being said, can't be too bad. So, I know sometimes USA people like to throw a pity party, but, could be a lot worse. Let's be real here. But that being said, look at other countries' stock markets and their performance over the last, 10, 20, 30, 50 years and tell me that we live in a bad place. So that being said, XLB materials have broken down from key support here where we had that descending triangle. We actually broke out to the upside. So now we have our 236 target right here at about 75. So 75 is a 236. Still have a way to go before we would get anywhere near other important sectors or other important supports rather. So still decent for now. It's a new low. It's not good, but it doesn't look nearly as terrible as a lot of the other sectors do, at least for now. So XLV, consumer discretionary. So obviously, we would expect consumer discretionary to be melting down as essentially the funny thing about spending is, consumer staples, everybody has to buy. Poor people spend all their money on consumer staples, below the poverty level, whatever. As far as consumer discretionary items, the majority of consumer discretionary are purchased by wealthier individuals. But because wealthier individuals tend to be more savvy or, intelligent, they see what's really happening in the economy because they're business owners or investors or whatever. They have more in touch in some ways and out of touch in many ways with the actual goings about of the economy. So if you have more of an in-depth feel of the business world and you see what's happening, it's more clear to you that things are starting to slow. So you start as an intelligent person, as an educated person, as a wealthy person, you start preserving that wealth by not doing reckless spending and whatnot. So that's why we often see consumer discretionary go down lower. Now, there's still plenty of poor people that buy consumer discretionary items. There's still plenty of rich people who buy consumer staple items, but it's just where the mentality of the spending comes from. And again, in no way am I being derogatory towards anyone who is poor or, talking great about anyone that's rich. It's not intended by that in any way. And obviously you guys all know that. But that being said, we're at some key support levels for now with these two touches right here, but we're not far away from those pre-Rona dump levels. And then if we just put our Fibonacci in place here from low to high, we know we're just off of the 0.5. We basically reclaimed the 382 and then broke back down. We have a little sort of double bottom going on right now. No clear support right here. And oftentimes if we're in a situation like this where we don't have a clear support, we flip to our next longest time frame and check, because we're typically at the 200 exponential and simple, and that's what's going on. So if it kind of feels like we're in like no man's land, there's usually either a 200 exponential or simple moving average, or like some sort of like important ascending support that we're not taking into account. So in this case, obviously it's the 200 exponential and simple. 200 exponential already confirmed bearish. 200 simple is very close. We're below it and it's nearly flat. This is not good, obviously. Not what you want to see. But, you know, no surprise, obviously, as, you know, this thing is playing out clockwork, honestly. So the 0.5 and the previous top were both at 132. So that's our next target area. Once we get down there, we can kind of reevaluate. Again, I would expect anytime we have a key fib and also our pre-Rona highs in the same place, that should be a very strong support. And then on top of that, with the weekly 200 exponential and simple, we're starting to see quite a few of these things get down to key support levels. And as always, we want to practice slinky theory. You know, we have a high, then we have a low, then the slinky, you know, whips its tail over top. We put in a lower high, and then we just go down to the next step. And then boom, we bounce that step. The slinky whips its tail up. We put in another lower high, and then we just go down to the next step. So we're never just going to go down in a straight line, you know, unless you're a crypto. Then you go straight from whatever price to zero and you get rug pulled. But in normal companies, that doesn't happen. We would expect slinky theory in full effect, as we see here in example. Patent pending on slinky theory, by the way. XLU. So utilities. Okay, so we've been discussing this move and how we talked about this area holding and how it's very important to hold. If we didn't hold the 200 exponential and simple, if we didn't hold our yellow support line right here, fast track down to the bottom of the channel, and boy, did we ever get it. And look at how these safety plays are holding up. Real estate, you know, utilities. These things are just getting absolutely wrecked, and they're supposed to be the safe places. You know, so not good. You know, people are getting scared. They don't know where to hide their money at. That being said, we are now at the bottom of this channel. We've broken down from it a couple times before. You know, this was a Rona capitulation. We have like our 2008 capitulation. But look at how crisp and clear this channel is. During literally from, you know, 2008, 2009 till about 2017, we spent about 90% of the time at the top of the channel. Excuse me. Since 2017 till current, we've spent about 90% of the time in the bottom of the channel. So one of two things going to happen right here. We had an option to move up into the top of the channel and start to reclaim that area. And now we're back down here at the bottom of the channel at support. So we had our chance to go higher. We couldn't do it. I mean, we put in a new high and then we put in a lower high, you know, bearish divergence breakdown. Or actually, I don't even know if we had divergence. But we got the breakdown basically off the heart line and we came down and retested the bottom of the range. So the biggest thing that we need to look out for right now, in my opinion, on utilities, and I'm not saying I expect this to go down. I don't expect utilities to go down. This is supposed to be one of the safety plays people run to when there's recession, etc. But the market sometimes knows that too and then takes advantage of that safety play, etc. So typically when we see a break to the downside out of a channel like this, or a break to an upside out of a channel like this, typically what happens is we retest the heart line and then we come back down to the bottom of the channel and then we'll see a break. We have retested the heart line here. We retested it here. We retested a couple times right here, and we're right back down to channel again. So the probability of a break now becomes exponentially more probable each time we keep coming down to the bottom. Now, it doesn't have to happen. Again, we saw a bunch of times where we found support, you know, along the way here, or a bunch of times we found resistance, but it's definitely worth paying attention to. We're at support right now, but if we get a breakdown from this level, it could get real nasty real fast. And again, if we just put in a fib from the lows to the highs, just so we have some nice little horizontals here as well, we'll know that we've technically broken down from the 236 right around where we're at right now. So if we lose this level that we're essentially at right now, this looks real nasty, because we just lose the 236, we lose the bottom of the channel, and then we start looking for, you know, basically like measured move breakdowns. I'm just stealing this because we obviously never broke down. A measured move breakdown would essentially be, you know, from the bottom of here to the heart line of the channel. Or if you're doing the entire channel, you know, you would take the move from the top of the channel to the bottom of the channel. And then essentially, that would be the full breakdown of the channel. So, you know, that's what we're basically looking at right there. Doesn't have to happen, but it's worth note that measure move breakdown here, we would see a 382 touch, and then it would take us to 0.5, And then the measure move of the entire channel would take us down to 618 or probably closer to 786. So at key support right now, do not want to see this breakdown any lower. If it does, it probably gets nasty. And I don't presume right now that all these things that have previously been, safety plays are going to succeed, because the most important thing to remember is that for the last 40 years, when people are pulling this data and saying, oh, this works in recession, this works in recession, this works in recession, and then you go back and check how many times when buying these certain sectors worked in a recession, but also we had record levels of inflation, and then all of a sudden you don't have any data points. So now all of a sudden it's like, oh wait, how valid is our theory? How valid is our, idea of where we need to shift our money? Well, it's not valid anymore, and that's the problem. So XLC is next, communication. Obviously, we came down to a key level on communication. We've already taken out the pre-Rona highs. We're very close now to the 618. That is obviously going to be our next target to the downside. We sort of front ran it a little bit here, but we broke down from key levels. So, 618 we got to look at. After that, this starts getting real nasty. And if we look at our weekly chart, it's actually already getting pretty nasty right here, because we can see we have basically round tripped this whole thing down here, and we don't see any signs of relief. Now, we do have obviously some key support, but the 618, again, the amount of time that we've spent above that level is really just this little hump right here and this little hump right here. The real support doesn't technically kick in until we're like in between like the 786 and 618, or the 886 and 618. So, the majority of the price action took place down here, and there's nothing left holding us up here except for two little peaks. So looks like we're looking at further downside on communication, which makes sense, obviously, because, the communication stocks are getting wrecked, and there's not really like a bullish case for them right now. Like, it's hard to even just like make something up. If somebody was like, argue why communication is bullish right now, I'd be like, meh, pass. Next, please. All right, so we'll throw a fib right here. We are on the XLK now. All right, there we go. I skip this one sometimes, looking at tech, just because we always look at like the NASDAQ. So this kind of encompasses it, but essentially we're at the 382. So we have quite a ways to go before we round trip that. But we are at some key support now. Next target would be the 0.5 at about 109.56. The thing is, we kind of front ran this 302 already, and that was our retest of the breakdown. So we might not see another pushback up here in the way that you would hope. If you were trying to take a bullish trade on this, obviously would be just a quick little scalp counter trend trade. And again, that's all we're talking about when we're looking at the at this counter trend trade. We're just looking for the last trade, the last confirmation of bearishness as we get rejected before we go lower. And it doesn't always work out, but it's one of the best trades for me. It's one of my favorite trades, is the transition trade, because it's just one last, like, I don't want to say it's an easy trade. It's not a gimme, but it's pretty reliable, and it's usually the last trade of the trend before we break down. And sometimes that trade ends up being the best possible, purchase you can get, because that ends up actually being the bottom, and then we don't confirm into the bear market. We retest the 200 exponential and simple, we break above them, we reclaim them as support, and then we continue to the upside, and then you literally bought the bottom. So, that's always nice too. So 382 kind of lines up with the descending channel right here. So that looks like some support, and then maybe if it draws out a little further, we get closer to like the 109 level. But again, obviously looking very weak. XLE energy. So we've been talking about this thing was looking like it was potentially going to be putting in a top here. Again, I try not to call tops because I don't want to like seem over cocky or confident or anything. But when we see the signs, it's worth paying attention to. And it does look pretty clear like we're topping. Now, we're close to getting the 821 cross the downside. We did confirm right here, and then we got picked back up and put in a new high. Here, we confirmed the 821 cross, hit the 200 exponential and simple. Here, we hit the 200 exponential and simple. Here, we reversed it and put in a new high. So, doesn't have to retest the 200 exponential and simple. Seems probable at this time. Hard sell signal, all red histograms, red slope line, 821 about to cross to the downside. So, about 70 looks pretty probable at this point in time. And then let's go to our monthly chart and just pay attention to this internal retracement. So we basically have come all the way from our peak right here in 2014 to our low right here. And then we've come all the way back up to 886. We don't have a clean resistance. that we got, rejected off of. I was expecting this like lightweight to double top and come up to here to 100. It could still do that. It's definitely cooling off. Initially I had targeted this as a 5-wave structure that's completed that will eventually turn into a macro 1. We'll have a 2 pull back to support at the 200 exponential and simple, and then the 3 will take us much higher to new all-time highs. That's how I see this playing out long term. On the what I'm calling wave 1 right here, we had a 78.6% retracement. On what I'm calling wave 3 right here, we had a 236 retracement. And then what I would call wave 5 right here, it would actually go, slightly higher than my target, obviously, but it would go up to where we topped out now. And that would be, we don't know technically yet, but, the 236 retracement would be 78, 76. The 382 retracement in purple would be 70, 71. And then the 0.5 or the 618 would be our target down here at 66 or a little lower, maybe closer to like 57. And that's going to be the internal retracement of, our 5th wave. And then at that point in time, if we're correct, and this is in fact the case, and we did just finish a 5-wave structure, we would then, expect initially a retrace to at least the 236, which would be 67.19, and a retest to 200 simple, possibly a little lower to the 382. I would still be very, very bullish. A retrace to like 55. And then again, that would essentially just be, just kind of looking at the macro on this, that would basically just be if we took another Elliott wave tool right here, this would basically just be our 1 right there. That's 1 through 5. And then we would come back down, retrace. That would be our 2. And then the 3 would go to a new all-time high. And then, continuation along that front. But that's why we're looking at for now on this. Now, still early. The monthly looks pretty tired up here. Could definitely cool down for a little bit. Doesn't have to, but it looks like it could. The weekly, again, showing some signs of exhaustion. Already got the hard sell. Have not left the bearish control zone or bullish control zone yet. We got a red histogram for now. Still holding up okay. 236 lines up with the weekly 21. So about $78 looks pretty reasonable right now. But again, be careful on this one because there's a lot of momentum behind it. A lot of people looking to pile into, the only thing that's been making money this year. So, we don't want to get bearish on the most bullish asset class. But never a bad idea to lock in some gains, honestly, or at least protect yourself with a stop. XTN, transportation, ETF. Transportation, obviously, just getting wrecked. We're already down here at the 382. We've hit our green box area. We hit the bottom of our descending channel or wedge support. We basically touched our 2018 high, all but our 2020 high right here as well. So at key support, do we go lower? Probably. It's going to take some time, though. It's going to have to get nasty to break down from these key support levels. So I think a lot of these ones that are at key support now probably just kind of go sideways a little bit. And then a lot of the ones that aren't quite there yet, that are just kind of hanging out in no man's land, probably going to catch up. And then eventually we'll see like a, asset class market wide kind of bounce. But again, we're still kind of looking for an eventual reversion to the mean top of the channel move. Don't have to get it, but it could take us up as high as like 85. I mean, what's up with UPS, man? Or FedEx? Got that big bounce on FedEx and it only moved the ETF that much? Come on, guys. All right, so semiconductor ETF. So XSD, you can use whichever one you want, obviously. But we want to look at transportation, obviously, very clearly toppy. You know what? I do want to actually go into just slightly more detail on this. So we've been talking about this macro trend taking place here. We saw a bottom in transportation 2011. We saw a top in 2015 and then breakdown from the channel. Nasty retracement. Bottom in 2015. New high in 2018. Top. And then again, nasty retracement after like a double or triple top. And then that was our Rona dump. And then that took us up in another channel to new all-time highs. When we left the channel, we came back up. We double top. And now we're melting back down. And then when we look at the actual 821 preparing to cross and just big nasty candles, continually, lower highs and lower lows. This looks real nasty right now. Now there's definitely some key support, but we know that transportation is one of, the 4 sectors or the 4 charts that we call, the apocalypse, 4 horsemen. So basically we have our first horseman right here in transportation. And the reason transportation is a signal is as transportation gets too expensive and starts to top out, we see slowing movement of goods throughout an economy, or movement of people, or movement of whatever throughout the economy. So as that slows, it tells us that overall the economy is slowing. So obviously this is, a leading indicator for like recession or depression. So then next we have the semiconductors. And again, leading indicator, we see obviously direct correlation. Semiconductors actually were putting in bearish divergence or topping out prior to the actual dump taking place. So again, the semiconductors were like giving us the heads up ahead of time that we're going to be going lower. So we're at key support right now. We're obviously in a bear market, but if we break down from these levels, it could get nasty, and we would expect, a pretty violent sell-off in the semi space. And, we've been talking about the rationale behind that and everything. Again, I'm not going to go into a ton of detail because we have a lot of charts to look at today. But obviously, we are paying close attention to the pre-Rona high right here. Still ways off of it as we're only at the 382. Next target to downside, if it does break down, we're looking at about 132. And then after that, we have the 618. And then that is our pre-Rona high of 112. And again, second horseman. And this is very much looking like, maybe this develops into one of these head and shoulders patterns. Again, the pattern is not as important as what the pattern is showing, basically. But it's essentially saying, we're coming back down to a key support level. Maybe we get a little bounce. Maybe this pathetic little shoulder was already the bounce. Maybe this bounce that we get is the retest of a 200 exponential and simple. That's our last bull play, the reversion to the mean play. We then get rejected and then, break down from there. And then we start to see, potential for, something like a measure move to the downside. And then obviously we can just go from, the top of the head to the bottom of the neck. Oh, that's not the right tool. So sorry. So the top of the head to the bottom of the neck. And then we'll essentially look for, breakdown and where that would potentially take us to, back down to that pre-Rona level, possibly even lower. But again, semiconductors go into everything. So if all of a sudden, we see semiconductors slowing, basically tells us everything's slowing. All of a sudden we see transportation slowing. Transportation is how everything gets around. So that tells us, hey, that's, warning number 2. And then next, obviously, we've been talking about this before it was popular, before anybody even knew what it meant. We're looking at the yield curve inversion on the weekly. This is our 210 chart right here. So obviously the 10 is represented in orange. The 2 is represented in blue. And then we have the master on here as well. And then the recessions are marked with these vertical white lines right here as well. So we see each time we hit this line, we basically went into recession as it rolled over to the downside. So on the way up, it's bullish, it hits the line. And then as it rolls over, we enter recession, and then the recession gets nasty. We enter recession, the recession gets nasty. We enter recession, the recession gets nasty. And then here we have basically taken out that previous high on the 8 and the 10. We're breaking out above the descending slope line right here. And then we know when this decides to roll over, which it might not yet. It might go up to 8 or 10 or who knows. Maybe it goes to 5. And then eventually we peak and then it rolls over. We don't know where it's going to roll over, but we know when it does, we're literally a couple months out from the recession confirming. And what I use for the actual recession indicator, this is sort of like the canary in the coal mine, the 210 spread. But what I use is, and we can turn off, let's turn off the price action so we can just see a little more clearly. I just want to look at the master right here. So we can see basically, we come up to the resistance or the 200 exponential and simple, etc. When the master flips over red right here on the weekly, that is at the recession. The master flips over red right here. We cross below the 200 exponential and simple. That's at the recession. And then again, master flips over red right here. We cross below the 200 exponential and simple. That marks a recession. So, and then once more, the 821 cross the downside. That marks a recession. And then we cross below 200 exponential and simple. This one obviously looks a little different just because of, what was taking place in the markets at the time. But now here we are still strengthening to the upside. So we're actually not that close to this flipping over, crossing back down, and then confirming into, the recession. So according to this, the recession may be further out than we think. But it doesn't take long for, a bunch of bullish momentum to flip back and then turn into bearish momentum. But the fact of the matter is, until something breaks, we're not going to see that pivot. And, you'll notice that these line up in specific times with those pivots taking place. This was 2018. The Powell is a little bitch pivot. This is our, 2007, basically like pivot prior to our global financial crisis. And then this is our 2001, pivot right after like the tech crisis. And then this is 1990 right here as well. So we see these are key times, throughout history when we basically were very, very close to catastrophic events in the markets. And, people didn't seem to have any idea. So when we were coming up to this resistance line right here and everything was gravy, nobody heard, about all this bad stuff. And, we were just barely into the tightening cycle and we were on autopilot and things were going gravy. And the next thing you know, it's like, oh, wait, the recession's alarm is sounding. And now, obviously, we're at that level again. So one of two things going to happen. We either break down here and go into a recession or we go parabolic. And maybe we don't go into a recession, or maybe we do go into a recession, but break the trend, which I think is the most likely thing to happen. I think most likely we're getting ready to break the downtrend and the rolling over, Fed loosening, kind of recession indicator. I think maybe we break out here, go parabolic, and we still enter into a recession. So again, could see something we have not seen previously taking place in these markets. And again, this is going back 40 years. So I always talk about the data and I'm like, careful using the same data we've used for 40 years because, I hate to say it, but this time really is different. So, all right, so that is our recession indicators. Okay, so all the sectors of the market. Let's look at DXY and then we'll go to crypto. I'm going to keep today relatively short just because the last couple have been long and we're already over an hour. So yeah, DXY still very strong. Broke out to a new high, coming back down, retesting it for support. Again, a bunch of green histograms, blue slope line, bullish control zone. All looks very bullish. For now, we have to be careful that it doesn't roll over and print some bearish divergence. So we want to see continuation on the indicator oscillators. We don't really care what the price does. As long as price doesn't roll over, as long as the indicator oscillators don't roll over, it's fine. If it starts to roll over, we're probably going to cool back down and then we'll start looking at some of these key levels for support. But again, right now, the Fed is tightening and 75 basis points, and we see other countries are doing, more money printing. So is the dollar going to strengthen compared to countries that are still printing money when we're, tightening? Probably going to strengthen. Yeah, I mean, it makes sense. Okay, so we're going to skip all these. We'll skip all these for today, and we'll do crypto. That makes sense. All right, so Bitcoin futures chart. So I'm not going to get into the whole details. Obviously, you guys have been watching the channel for any amount of time. We absolutely crushed it. We killed it on another move, another perfect touch of our targets. So, obviously now it's like, well, yeah, of course 20K was an obvious target. Well, sure. Okay, I've been saying that we were going to 20K since we were at 70K, and everybody else was saying we were going to 100K and a million and all that. So we've absolutely nailed these moves to the downside. That being said, we just hit the 382 perfectly. So if we come all the way back here to our previous bear market low at around $3,000 and we charted all the way up to like 70,000, we basically have hit our 382 of the retracement of this entire bull cycle. So key support, obviously, and then also very important because that was our previous all-time high. So we've already done something we've never done before, which is revisit the previous all-time high. So this is the first time ever in history of all the existence of all Bitcoin that it has ever put in a peak in one bull market and then in the bear market following come down and put in a lower low than the previous peak. So that is not good. That's the beginning of something looking different. And when things look different, they're less reliable. So you got to really be careful to protect yourself, especially when everybody is saying, of course, we're going down to 20K. We have to retest it for support before we go higher. Duh. Everybody knows that. Sure. Okay. Well, let's see if it holds as support first, because right now this chart looks nasty. On the daily, it's absolutely nasty. New lows. And you know what we were just talking about? We were literally just talking about, let's go to our monthly chart right here. And this literally played out exactly what we said, didn't it? We were just saying how there was one candle between $20,000 and $30,000. There was 1 month worth of price action in all of Bitcoin's existence that was going to act as support. And I said specifically, it would not surprise me to see one single candle down wipe out from 30,000 to 20,000. And then we'll see, who's really a hodler as tons and tons of people, tons of price action comes in at all-time highs when you break it, because you essentially have a blue sky breakout. So we have a blue sky breakout, and now we have completely wrecked that, come back down, retested as support. Looks absolutely ferocious. atrocious. I think I'm making up words right now. Terrible. Terrible. So if we look at our Bitcoin spot chart on Bitstamp, again, you know, when we look at the actual breakdown of the chart and what we have going on, it's obviously a lot. It's very busy, but it's sure starting to look like we were right about all these theories about the 5-wave structure, you know, the expanded flat ABC. We already hit the 1.382 target to the downside for the fib extension from the low to the high. So again, we hit a perfect target. We bounced off of it. That also lines up for confluence with the 382 from our bear market low in 2018. I'm sorry. Well, yeah, technically it's 2018. From 2018. So now we've hit key levels of confluence right here. You know, we hit the previous all-time high. We hit the bear market fib extension, or 382. We hit the fib extension from the C wave, from the B wave. I mean, we've hit a lot of targets here. So I don't want to get bearish at 20,000, which is why we took some scalp plays on Bitcoin and Ethereum temporarily on shorter time frames. So looks good for now. We saw a little bit of bullish divergence developing on the hourly and also on the 4-hourly as well. Saw the cross on the 821 on the hourly back to the upside and cross above the 200 exponential and simple on shorter time frame, like 15-minute. So decided to take a little scalp move there. We'll see where it goes. You know, we're hitting key support. We're bouncing key levels. Not trying to get bullish by any means at this point in time, but, you know, obviously saw some upside potential already. So that being said, now we have done the retest of the 200 simple that we've been calling for. Obviously 200 exponential has flipped over bearish. We're at the 200 simple. We know historically the 200 exponential and simple have acted as support every time we've come down to them. Now the Rona dump, we did capitulate through that. So it is possible that we go lower before we go higher. It's also possible this doesn't work this time because things have changed. It's 100% possible. But we do know that there's going to be a lot of people assuming that this is the bottom, or assuming that this is support, or assuming that this is going to hold. So that being said, if enough market participants feel that way, we could get a nice pop out of these levels. You know, we could potentially even get a pop back up to like the high 20s or low 30s. So we're paying attention to that. It's very important that we pay attention to this monthly as well. I talked about this before, and again, I'm not trying to get bullish. I'm not saying this is a bottom. I'm not saying this is a buy. I'm not saying any of that stuff. Obviously, none of this financial advice. I'm not your financial advisor. Markets are extremely volatile. Please do your own research, trade responsibly. What we do know, though, is the monthly cross took place in January of 2015 on the 821, and that was also the absolute bottom of Bitcoin's price at $151. And then the next cycle, we know that the 821 cross, the bear cross on the monthly, happened in December of 2018, and that was also the absolute bottom on Bitcoin. And then finally, the 821 cross is all but about to happen. So we're like 15 days away from the end of the month. 2 weeks from now, you know, we close down here. It confirms across the downside. And then next month, there is a possibility based on historic, you know, reference right here. It's a possibility that next month's candle is the bottom for Bitcoin. Now, is it going to be at 14,000? Is it going to be at 10,000? Is it going to be at 8,000? I mean, I don't know. Is it even going to be the bottom? I don't know. But there's at least an argument to be made for the last 2 times 821 crossed the downside that was actually the bottom. So next month, we're going to be paying close attention to price action and where it actually goes. Now, it's also the beginning of, you know, I mean, the trend is still strengthening to the downside. So we don't get too excited and just say this has to be the bottom because it happened last time, but it's worth paying attention to. I'll put it that way. So Bitcoin still looking pretty bad right now. We did get a pretty bullish hammer right here. Nice wick rejection of the downside after sort of an indecision wick rejection of the downside prior to that. And then it did close bullish, and so far we're bullish now. So, you know, on a daily time frame, it would make sense that we retest like 24,850 or 24 something, as we'd basically just be retesting the 8 moving average on the daily. Still see all red histograms, red slope line on the TDMACD. We still see a hard sell. We're now in the bearish control zone, and we see stochastics are still trending to the downside. So does not have to get an overperformance move right here. Matter of fact, if I was a market maker, if I was a whale, if I was a, you know, big boy out there, what I would do is I would force liquidation, capitulation through 20,000 just because everybody's expecting that to hold. And then I would take advantage of wherever it goes from there. That's what I would do. But what do I know? So Ethereum, same thing. Had a slightly more bullish rejection the day before. And then obviously nice little hammer candle in right there. We were able to enter that position from a lower price and move our stop loss to break even. But we're looking at roughly 20% upside with it was about a 5% stop loss. And immediately moved in our favor though. Always want to move the stop loss to break even as soon as we get any kind of margin. So we can be in a free trade. If we get stopped out, who cares? If we, continue to the upside, we're protected, and that's even better, obviously. But overall, Ethereum looks terrible. Absolutely horrendous. But could bounce this level. All we did was hit the levels we talked about. I mean, when we were talking about this, everybody was like, Ethereum will never go below 2,000 again. You're stupid. Oh. And then it's like, Ethereum will never go to $1,000 again. You're stupid. Oh. And it's not like it just goes to $1,000. It literally went to the 382 and $1,000 perfectly. What was the low? $1,013 on Bitstamp and, exactly at the 382. So, science here, okay? It's easy. I mean, we make it look easy at least. But anyway, clear support right there, but looks very weak. So short term, sure, we're looking for some scalps, some bounces, some potential bullish action. But again, probability of success is below 50% because we're trading against the trend. But again, we've had some pretty serious downside in the last 72 days, so 2 months. Ethereum has lost 71% of its value. That's not even from all-time high either. That's just in the last 72 days. So this thing has gotten beat down. One could argue that it has been brutalized and left for dead. Bitcoin dominance playing out very nicely. So we got the breakout to the upside. We confirmed above that previous high right here, got a nice close. And now we're having a nice little sell-off coming back down, retesting the 8, potentially come back down to the 21 and the top of our what was resistance to act as support. And then at that point in time, we could see the remainder of the measure move or move back up to the 1. Most important thing, though, is when this does come back down, we want to see this level hold as support, and then we can get continuation to the upside. So we have a break, we have a retest, and then we expect that retest to hold and see continuation. And this has been playing out very nicely off that triple bullish divergence. Total market cap did exactly what we said. Busted through the 200 exponential, came down exactly to the 200 simple. We hit our new target of 845 billion. For some reason, I was the only one excited. I don't know. When we hit 845 billion here, everybody was super excited. Everybody was pumped. Crypto was going to, trillion. And then it was like Bitcoin to $1 million bucks and everybody was excited. I don't know why no one's excited now that we hit 840 billion. I mean, we should be just as excited on the way up as on the way down, right? Right? Oh, and I remember saying back here when we were at 2 trillion, I said, just so you know, we're going to 1 trillion. So whatever your favorite crypto looks like right now, think about what it's going to look like when it's half as much. And, since then, we have literally just completely melted down. So, once again, nailed it. Matic. So Matic has lost that key level of support, which was that potential bottom. So it's just continuing to just put in, lower lows. So at this point in time, we can't even really validate this fib at all. It's basically just melting down. So we have a macro fib going back to May 19th, all the way from the bottom to the top right here. Arguably, it could be drawn slightly different. We'll have to see. It looks like some pretty good confluence with the 236. So that's our 200 exponential and simple. The 382 is down here at like 19 cents. So again, I mean, I would not be surprised to see an attempted retest at the breakdown level at like 56. But, counter trend trades, it's got to be perfect for it to be worth it. AVAX, Avalanche. Oh, you know what I did? I switched a couple of these to Binance, so they would have like a little more history. All right, so yeah, we came down below the slightly front run the 618, back up retesting the 0.5. So we're between these two key fibs. So a retest of 0.5, maybe we come back up to 382. Excuse me, a retest of 618, and eventually, I mean, we don't want to break down from these levels. Man, this thing's just this thing's got nothing but nasty waiting. I mean, it's either going to go up or down by like 50% quick. Starting to build some momentum. There's a lot of bullish divergence developing on some of these charts. We have basically a low right here, then a lower low right here, then a lower low right here. And here we see, a low right here, a higher low right here, and a higher low right here. So we have triple bullish divergence developing. Looks okay. Got to be real careful with these altcoins right now. Solana is next. Again, from the bottom, May 2020 to the top. We've already put in, I know it seemed crazy at the time when I was like, we probably top and put in like an ABC, like nasty correction. And then now we did actually go slightly higher than that from when I was saying that was potentially the top. But in all actuality, we're right on track for what I was saying. We've already made it down the majority of the way. We hit the 382. Next target would be the 0.5, and then after that, 618. Doesn't have to go down to the 618. Could go lower. Could go, more of a shallow retrace. But looks, again, key support right here at the 382. A bunch of like bottoming. But after that, the 0.5. I mean, this thing looks like it wants to lose 66% of its value fast if it goes down. But again, obviously I'm at least short term scalp bullish right now. Algo is just melting down. From low to high. We'll just go by the wicks. Yeah, it looks pretty good. I mean, we see some very, very clear. This is trading very, very technically. I mean, look at these touches on the 382 right here. I mean, a perfect touch right here. Clear support through here. And then break down to the 0.5 perfectly. Retest perfectly the 382. And then break down straight to the 618. Retest the 0.5. Break down below the 618. So next target to downside would be 786 at about 20 cents. And we're at resistance right now. And it tried to push up aggressively and it's getting rejected. So, it's on the daily though. It's just the beginning of the day. So try to have a nice little rally right off the bat. Or I guess that would have been the end of a candle that just closed. Got rejected. So this actually still looks pretty weak in comparison. XRP is... So it dropped down. Man, it got... Let me put in the fib from here. All right, so it got down to the 618, bounced back up, consolidated, broke down through it, and now the 618 is acting as resistance. So downside target-wise, next target's like 21 cents. This thing fully round-tripped. God, this is trash. Cardano, okay, so we hit our target, double bottom here on that 382, came straight back down to it. It's holding support for now. We still have some kind of weird, like, descending kind of channel / broadening wedge action going on. At key support at the 382, trying to pick up a little bit of momentum. At the heart line as well. I wonder if this one wants to pop up. It actually looks like it does. I mean, but you're almost like too late from right here. You don't want to buy right now. You want to get it a little lower. You really want to buy that pullback. So Cardano's actually holding up, since we got down to this low, much better. Everything else like capitulated through here and saw new lows. Cardano at least kind of like held that level. I mean, it's still trash and Charles is a bum, but the actual asset like trade action doesn't look terrible. Yeah, you really got to get this lower. I mean, it's like 3-1 from here, but the margins are just ridiculous. Like 20% stop loss for 60% potential gains. You have to just run a super tight stop loss, or you really just got to get a better entry. Got to get it at like 44 cents. So KNC broke down, put in a new low. Massive amount of support at this level. No surprise whatsoever that this held. So depending on how we're looking at this, if we just go from the low back here, and we just go to the high right here, yeah, that's like perfect 786 action right there. So we don't want to see it retrace any deeper. But as far as I'm concerned right now, as long as we're below the 618, which is where we're at right now, we're just range bound between the 618 and the 786. If we get back above 618, then maybe we move up to 0.5. So we're looking at $2 upside target. We're looking at, $1.10 downside target, and we're right at $1.50. So it's like coin toss at this point in time. We're seeing a little bit of bullish divergence developing. These markets have got pretty beat down. So the real problem is crypto has gotten beat down really badly. So if stock market really does decide that it doesn't like this 75-point rate hike, or that it's not priced in, or the future rate hike of 50 or 75 basis points not priced in, markets could get nasty, and crypto is not going to be spared by any means. Hex. So Hex broke down. What was our target? Did we hit it? Not quite. Okay, so we almost hit it. 32. We had it down here slightly lower. So we almost made it to 618. We almost made the measure move breakdown. We cleared the 0.5. We're retesting as resistance. I expect it to roll over and go to the 618. And then finally we have waves. Very clearly breaking down. Pretty aggressive bear market going on. I don't know about that wick. We'll see. Oh, okay, yeah. So the wick actually is pretty technical. So perfect touch of 0.5. Holding for now. Already kind of retested. Maybe it retests the 382. 784. I mean, that's like a freaking 50% move, right? Yeah, that's 51% from where we're at right now. I just don't know if we can get a decent looking trade set up without getting a nice entry off support. Because realistically, I wouldn't want to hold it if it went too far down. That's only like 2 to 1. It's 22% stop loss with 50% upside. Got to get a better entry on that. Closer to the 0.5. Which obviously that would have been the opportunity to do it on that last push down. But, it is what it is. So yeah, that's our crypto for today. So we got through all the sectors of the stock market. We got through the major 4 indexes, 10-year, 210 spread, the DXY, all the cryptos. I'd say that was a pretty productive day. And about hour and 31 minutes. That's legit. Oh my gosh. You guys need to tell me there's robots in here. We got our bots back. Yay. I thought YouTube gave up on us, man. Surprised anyone knew I was even able to find the channel. All right. So anyway, let me jump back in here. The comments. What's going on, Sohail? Good to see you. Bonsoir to you as well, my friend. Arturo, good to see you, man. Late but great in the room. Hey, happy to see you, brother. Late but not forgotten. Geo Luke says, hey all, so glad I finally got a chance to listen live. Being in Australia, time zone sucks balls. Heard that, man. We got a couple of Australians in the community, so I completely understand. We do that Friday early stream. That's 11 a.m. Eastern Standard Time. So that's probably the best one for you to be able to catch them live. But glad you could make it today, Geo Luke. All right, and then what do I got to do to... All right, so yeah, so we got a probably crypto spammer or something there. I don't know what's going on. Oh no, probably porn spammer. Nice. Congratulations, YouTube. Why don't you do your job and get rid of these trash people or robots? So Shadow Supra says, hopefully the Fed rates go up more. I have a big down payment for a house. Yeah, no doubt, man. No doubt. I mean, the truth of the matter is we can't have high house prices and high interest rates. It just doesn't work. Historically speaking, you're double overpaying. Because in the past, the argument was, well, sure, you're overpaying for the house. You're buying it at ridiculously high prices, but the rate's so low, it works out in the long run. And then the argument was the opposite. When the rates are really high, you're like, well, the prices are really low. So, it's not that bad. But when the rates are high and the prices are high, it's going to absolutely kill the market. I mean, if there was ever a perfect example of the cure for higher prices is higher prices, I would say it's the housing market right now. When we start to look at the housing data, and we've been talking about it in advance to it all happening, and now we're seeing it in mass. We're seeing layoffs from, housing related companies. We're seeing record low, applications for refinances and new agreements. I mean, we're literally everything we talked about, days on market, a number of new listings, the amount of supply that's on the market, like monthly supply that's on the market. All these things are coming to true now. I mean, it's everything we expected. Now, depending on your area, some areas are going to hold up better than others. Some are going to get wrecked much worse than others. There's a lot of like, I don't want to say like trashy places around the United States, but like, let's be real. There's a lot of trashy places around the United States where the housing price like barely have moved or not even high at all. You can still buy a house for nothing. And then there's other places where the houses have, doubled in value in the last 2 years. So if you're in one of the places where it doubled in value, you're probably going to see a much deeper pullback if the demand doesn't continue. If you're in one of the places where the price barely moved, you're probably not going to see some big reset in prices. The most important thing I would probably pay attention to is like the relative affordability of the housing market based on like local wages, because it's all good and fine when people are migrating to an area with like a bunch of money. If you're coming from like California or New York or, another country where cost of living was extremely high. So you're moving down to a cheaper place, but it's still, not like dirt cheap by any means. It's just cheap to you relative to what you were making or what your previous house was valued at. But then if that demand doesn't last, which is not going to, is a one-time migration effect out of cities. We'll see some continue to happen over time, but it's not like this is just like nobody ever wants to live in a city again. It was more like a one-time thing. Some people will go back, other people will, start a new way of life, etc. But the fact of the matter is, once that new migration demand starts drying up for those houses, it relies on the consistent buyers. And the consistent buyers are, the same people that have always lived in these towns, cities, whatever, and they have to be able to afford these houses on local wages. Or else once that exodus migration demand dries up, housing prices just absolutely crash. Because unlike what people realize, there's not always like a ton of transactions taking place in the housing market in a local area the same way there is in like a stock market. Like the liquidity is completely different. So if all of a sudden your neighbor, you live in a community with 10 houses in it, and, your house is worth $100,000 according to that last house that was sold. If all of a sudden your neighbor puts their house up for $90,000, and then one of your other neighbors puts their house up for $85,000, and then another neighbor puts their house up for $80,000, all of a sudden you have that same kind of like bidding war, but to the downside. And the relative value of the houses are relative to the ones around them, like comparable, homes. So if all of a sudden you don't have to sell your house for the price to go down or the value or the perceived value to go down, but if the other houses around you start selling, and then that can cause that frenzy, like essentially like what we see in stock markets, where a bunch of sellers are just trying to get out at the best prices they can. And as we see rates continue to rise, there's going to be less buyers because you have to have better credit and more money down and be willing to pay a higher interest rate over time. And that's 3 reasons that people might not want to buy a house, let alone all 3 of them together. So I think we're going to see a pretty heavy correction in some of these housing markets. Others might not be nearly as bad though, but I think it's going to be relative also to, what really happened. No way, man. Man, these damn robots. But yeah, I think we're gonna go ahead and wrap it up there. I do plan on doing a like full comprehensive breakdown of the Fed dot plot and everything and discussing it. But the most important thing to factor in right now, and what we know already, is that even if the Fed is completely right about everything, they're so screwed, man. Because if they're right and they have to raise rates and they have a soft landing, we still have a technical breakout of the treasury market, and therefore like bond market is crashing. And then, that's going to cause further crashing in the stock market. So, and then if the Fed is wrong and they raise rates too slowly and inflation gets out of control, it's the same thing. They're still screwed. So either way, there's no winning on this situation, in my opinion. In my opinion, the only way we literally see this change, the only way I can literally see a positive outcome on this as far as like Fed credibility and success in this situation, which they've already failed 99 out of the 100 questions. There's one question left. So even if they get this, question correct, they still fail the test because they're garbage, they're trash, they're useless human beings. But the fact of the matter is, if the Fed is not able to get inflation under control versus if the Fed is able to get inflation under control, either way, we sort of end up in the same scenario because we have a breakout of the treasury market, a breakout of the DXY. And then the real question is, well, do we just end up with prolonged inflation, or do we crush the inflation and the economy and end up in recession? So either one sucks, right? So if we're in a recession, it's bad. If we're in, inflationary period that lasts, 2, 5, 10 years, it's bad. So there's no winning. There's no possible scenario that I could see right now where the Fed gets out of this. Literally the scenario would have to be, the only scenario I could see where this ends up good is, short to medium term, economically or stock market wise. The only way I could see this working out good is if the if the Fed is able to raise rates enough that it crushes inflation, slows it down, supply chain bottlenecks sort of alleviate, things kind of go back to normal, everything relaxes, the economy slows down, but somehow they're able to maintain, a super low unemployment rate. And then we just grind sideways for long enough that we're kind of able to build up some momentum and recover. But even in those scenarios, at what point in time does the Fed start loosening again? They're not going to. We're literally at the beginning of a tightening cycle, and their plan is over the next 2 to 4 years, they're going to run off trillions of dollars off the balance sheet. So they're going to go from net buyers to net sellers. I just don't see it. I don't see how it goes well. I think we end up in a period of extreme volatility. I think for a little bit we see inflation go up, then a little bit we see it coming down, and then all of a sudden it shoots back up, and then it starts coming back down. And I think we're just going to see this nasty, just crazy whipsaw volatility effect. And either way, I don't see them getting, what they want. Because if they're right about all their dot plots and they're right about where the Fed funds rate has to go, then the bond, market is going to be getting absolutely destroyed. And if the bond market gets destroyed, the selling in the bond market is going to cause mass selling in the stock market. And the size of the bond market is going to shadow the size of the stock market. So we're going to see another, how many trillion? I mean, I think we've already destroyed something like $15 to $20 trillion worth of value. So, what's another 5, 10 trillion on top of that? I would think they want to do it over a longer period, like a 5-year period, not over 6 months. But hey, you know what? It is what it is. But that being said, I'm going to jump back in the comments and we're going to wrap it up, guys. So Geo Luke says, RE housing. So true here in Australia as well. We are so over leveraged. Our bank's 70% exposed to housing. Next GFC starts here. What you're describing is just starting now, and it's going to get messy. Yeah, I mean, Luke, you're right. It's not even just Australia either. Australia and New Zealand are two historically expensive housing markets. Canada as well. And then we have quite a few places in the United States. Now, in comparison, multiple-wise, we're not nearly as bad. But that doesn't mean we don't still see, nasty, movements in the market. So, and then Prague says, can you show how you set up ETH fib levels showing 1,000 was a good buy? Yeah, we can pull that back up real quick, brother. So obviously 1,000, that was one thing we talked about in last stream. 1,000 would be a very nice target because it's a nice round number and people like round numbers. But this is my Ethereum chart right here going back. Now keep in mind it's a little nasty, but if you go back to March of 2020 and you take that low right there in March of 2020 and then you fib all the way to the high, which was in November of 2021. And then just make sure that you have log scale selected right here at the bottom. And then if you double click on your fib as well, scroll down to the bottom of this, and then you'll see here at the bottom, there's a box that says fib level based on log scale. Make sure that you click fib level based on log scale and it turns blue with the check mark. And then that will give you this same fib that I have right here. If, for instance, you don't have the fib based on log scale, it's going to look all messed up like this. See how the 886 shifted up and now here we're at the 786? And then if we re-click it, the 886 is down here and the 786 is down here. And now here we're at the 382. It's because we're in the log scale setting and then we want to make sure that our fib is based on log scale. So make sure that you do that. And then from there, all I did was just draw an ascending channel on the way up. And then once we lost the ascending channel, and then we paid attention to like the lower high right here, basically. And that was the beginning of our downtrend. And that's how we were able to call the 236 perfectly as support around like 1800. And then, of course, the 382 perfectly around 1000. And, you know, that was obviously our target. Got hit perfectly. And then if we just flip over to the weekly as well, you'll see one more level of confluence also. So we have the 200 exponential at 1640. And the 200 simple is where we're sitting on top of right now at 1217. And obviously, the more confluence we have, the more reliable it is. You know, just more things telling us the same thing. I mean, they just literally let this people come back over and over again, even after you like hide them. I mean, YouTube is so pathetic. Like, they can't figure out somebody with the name naked, fuck, and sex in their name. They can't figure out that that's maybe a scammer or should be banned. I mean, dear God, YouTube is such trash. I mean, YouTube, you're amazing and so great. Thank you so much for this opportunity to share with good people on the internet that wouldn't be possible without you. Whew, we did it. So Price says, do you draw from cycle low? Well, in that case, it's not actually the cycle low, but yeah, for the macro fib, you would. Very helpful. Of course, brother. Yep, anytime. So yeah, we're going to go ahead and wrap it up there. Hopefully everybody enjoyed the stream today. Hopefully you learned something. If you guys have future oh, you know what I'm sorry. You know what I almost did again? I have some requests too that I didn't do the other day that I need to do really quick. So sorry about that. So we're actually going to do a couple more assets here. So we have the Altria move right here. So we were talking about basically this ascending support, you know, ascending resistance. We got the pullback to the level we were paying attention to, but we were talking about how nasty this looked and we didn't expect to get there as quick. So we started paying attention to the bottom of the channel. We actually broke through the bottom of the channel now. So this is looking pretty nasty. Now, does not mean we can't still get another entry. We didn't actually ever take this trade right here. That was like our, you know, we're looking for basically that area to hold. But obviously now we're not going to take it. But, you know, we're looking for our next level down right here and look for opportunity. I don't like that we lost this ascending support right here. And we could easily see a measure move breakdown, possibly as low as like revisiting the lows. So this looks pretty nasty right now. Worth watching. I still like it long term. But, you know, obviously that was not, you know, it looked like it was going to be a good entry if we got there. We got there so fast and so aggressively that it didn't look good once we got there. And that's fine. If we have a hypothetical and we want the price to get to that target so we can take an entry, and then when we get there it looks nasty, it's perfectly fine for us not to take that entry or wait for further confirmation. Because, you know, we don't want to just be like, well, I did say I was going to take an entry at that level, and then it just capitulates on you and you're like, yeah, there was probably some warning signs. So Craft, okay, so Craft's another one we've been talking about where we said if this area held, we have the same longer term like ascending support right here. And we were talking about if that held, if the 200 exponential and simple held, if the Fibonacci level held, that we would want to take a entry from there. And then actually what happened was we lost that level, came back up and retested it as resistance. And we know what that means. We lose a key support, we retest it as resistance, it holds as resistance, and then we typically see lower prices. So any potential that we had for this trade setup is going to be invalidated. I believe, yeah, okay. So, but that was just a potential entry right here. Obviously looked less reliable, but this is the real setup that we want. This is the winner. And that is if we break down from here and come down to that 29 level, that's where we're looking for an entry. And we have a setup in play for 5.6% stop loss, 25% upside with a 4.5 to 1 risk reward ratio. It is counter trend, so the probability of success is going to be below 50%. But that does not mean at an almost 5 to 1 risk reward ratio, this would not be a beautiful trade. So, but we got to get there, you know, and again, that's the beauty of having multiple potential setups in play and invalidation points. Even if we don't take the trade, we've already predetermined where our invalidation is. And the invalidation is if we can't reclaim the 200 exponential and simple and the ascending support right here on KHC, the Kraft Heinz Company. All right, so next we have Cabot Corporation, CBT, as per request. So let's switch out to a longer time frame and just kind of get a broad picture here. So obviously this thing is in a nice bull trend, putting in consistently higher highs and higher lows. Looks very strong above the 200 exponential and simple. We're getting a hard buy signal at the top of the range. Oftentimes those will be false signals or failures. So we do have to be careful here. It is not putting in any kind of divergence or anything. Still looks relatively strong. Did reclaim the 200 exponential and simple, retested it, and then moved to new highs. So we're at support, which was the previous high levels from back in 2018. So we want to see this level hold for sure. Definitely want to see this level hold. And then if we just take a fib from the bottom of March 2020, our Rona dump, up to the top right here, we assume for now this is our high. We can't actually have that validated until we come down to at least the 236. What would that be? It would be probably a retest of 200 exponential and simple. So if it comes down to about 57, wow, that's a pretty aggressive downside move. Comes down to 57 and holds, that's actually, a good place to be. I mean, that's another 15%. I guess it's not terrible. But here on the weekly, we do see some bearish divergence. So we have a high right here. We have a lower high right here internally. And then we have a high right here and a lower high right here externally. And the difference being this is in a move towards the zero line. So it could easily be an internal portion of a bigger move. As we're here, we're up above the zero line. Then we're below the zero line. Then we're up above the zero line again, but we're lower. So that's the difference between two external peaks and an internal set of peaks. Both are viable for bearish divergence because here we have a high and then we have a higher high, and here we have a high and a lower high and then another lower high. So again, either double or triple bearish divergence taking place on this chart. And that's going back to June of 2021. So this is established bearish divergence on the weekly. And we know that this was showing up on pretty much all of our indexes and cryptos and everything right before we got the big dumps. So is this going to be the beginning of that dump? We don't know yet, but we at least have some targets to the downside. So we're looking for a 236 entry or potentially as low as the 200s or 382. But overall, this thing does look pretty good on longer time frames. It looks pretty good on shorter time frame as well. I mean, it looks healthy still, I should say. The 200 exponential has retaken the 200 simple, so that's good. But the weekly time frame tells us that there's probably more downside potential. So we'll pay attention to that. We'll keep doing these. Keep up with them for the next couple of weeks or whatever, as long as you're still interested. HUSA next, Houston American Energy Corporation. So we talked about this one. Everybody was calling this like a big like meme stock or short squeeze. But in all actuality, if it was anything other than energy, I might agree. But in all actuality, what we see taking place right here is we see the cross of the 821 back to the upside, giving us like potential for, an actual bull trend. And again, we see here on the weekly, this thing crossed down into weekly bearish territory on February 2012. And really what it did right here was just get back above the 200 exponential and simple, parabolic, retest, and then it's holding for now. So the longer this goes sideways right now, actually the better it looks. It's so wild that they can just keep coming back in here and just spamming, stuff like, how can you have naked whores, cheap fuck dates in your name? And that's okay with YouTube. Like, YouTube, really? You have no problem with naked whores, fuck dates? Okay, cool. All right, YouTube. But anyway, so this actually looks good as long as it's holding above here. Now, again, got to be careful of some potential bearish divergence, but all it has to do is just keep trending the oscillator to the upside. So this actually looks okay considering. Now, is it a meme stock? I mean, arguably you could say that, but this is an energy stock that's like way down off of its 2014 highs, or 2011. I'm sorry, highs. So it's been getting absolutely wrecked. Now, is it just starting a bull trend now? Maybe. Could it underperform? Also maybe. But what did we do? We basically hit the bottom here, came back up and did a 50% retracement. Almost made it back up to 200 exponential and simple, which is a 618. So realistically, if we get a close on the monthly above 955, it's going to look pretty darn juicy. And again, we're above the 200 exponential and simple. So, this is a pretty freaking good entry point. You guys have seen all over my charts I draw these things, like you'll see the one like this, and it'll be a red or pink or something circle or something like that. That's when we cross below the 200 exponential and simple and confirm into a bear market. And then when we come right here and we cross above the 200 exponential and simple, we confirm into a bull market, that's our entry. So the idea being that we get out right here when it looks nasty, and then we get back in when it looks good. And then even if we only ride it back up to the 0.5 or the 618 or the 786, and it doesn't even put in a new all-time high, the level of movement and the probability of this momentum, play. I mean, back to the 786 is a 2,000% move to the upside from that 236. So, does it get there? We don't know, but, there's an argument to be made that there's some legitimacy to this. Now, I'm not looking at their financials. I'm not looking at anything like that. I'm talking about just strictly the technicals. That's what I would be looking out for is, potentially if we topped right here at the 382 for now, I would expect us to come back down, put in another higher low. So here's our low, here's our higher low. So you just want to see another higher low. So you don't want to break below 341. So that would be an entrance for me with the target of the 382 or more realistically a 0.5. We already technically hit both those. So in all reality, I'd be looking for 618. So while I wouldn't get greedy, and maybe just take some profits along the way up, that's what I'm really looking for. And we might be able to get an entry slightly lower, closer to the 236. But, from where we're at right now, assuming that we only make it back to a 0.5, it's a 53% stop loss with 155 upside versus the 618 gives you that 400% with 53%. Now, granted, that's an 8-to-1 risk-reward ratio. It's great, but you're like, well, I don't want to lose 53% of what I put into it. Well, there's an easy way to do that, and it's called position sizing. So if the stop loss is too big that you don't want to use that, but the risk reward is so high that you're not worried about it, you just take a smaller position size. So then you can just calculate it reverse. Instead of normally saying, I want to enter into this position and my position is going to be $100 and I'm willing to risk $10 of that because there's $30 in upside. So that's 3-to-1 risk reward ratio. And then, if you had $100 and you get stopped out, you lost $10. You can calculate it the other way around and you can say, okay, this is a 53% stop loss and I'm only willing to lose $10. So what does that mean your position is going to be? You're going to enter into a $20 position, 53%, you lose $10. And then if you enter $20 and then you hit your target to the upside, it's 401% upside. So you end up with $80. And then you still only risk $10. So even if the actual stop loss is really big, which I don't love doing, I like to have tight stops, as long as you do your position sizing accordingly, you can take a big stop loss with a big upside as long as the risk reward is there. But just make sure that your position size lines up. Because if you take that same position at a $100 position and then you take a 50% drawdown, you lost $50 and you only wanted to lose 10. So you need to have a smaller position size to make up for the bigger stop loss and just make sure you have clear definable areas. And it's very, very important, no matter how big or small the stop loss is, that the risk reward is always in your favor. At least 2-to-1 in a bullish trend, at least 3-to-1 in a bearish trend, and the higher the better in both cases. So that being said, we'll keep an eye on this one. I do suspect we'll probably be able to get a lower entry closer to 337. I wouldn't jump on this right away. We just saw some big heavy pullbacks in nat gas. I don't know how reliable that's going to be on the whole space, but oil, obviously we're seeing some potential weakness as well. So we'll see how it all plays out. I don't want to get too aggressive, but the truth is, man, the energy play has been great. I think there's still a ton of upside over the long term. But short term, we're definitely reaching some potential levels of exhaustion. Nat gas went down 25% in one day, so definitely seeing some exhaustion. No surprise, though. Bearish divergence for sure. Looking very toppy. So ENI is next. So if we look at the longer term here, again, we have a daily chart. We're above the 200 exponential and simple. We have retested it now for the first time since July of 2021. It's holding up for now. We're at that level. What we want to see is an aggressive rejection of the 200 exponential and simple. So every time we come down to it, we want to see aggressively pull away and then new all-time high. Now, one thing that alarms me about this right here is it could be okay, but the 200 simple has just crossed above the 200 exponential. So we know what that means. It means the trend is coming to an end. Doesn't mean it can't put in a new high before the end of the trend, but it's just saying hey, the trend is definitely weakening. The 200 simple lags, so it's still crossing above. The the 200 exponential is getting weak. So maybe we see another pop up here, maybe even a new high, and then we come back down. The next retest of a 200 exponential and simple is crucial. Maybe we just fall through it right now. But the truth is, we don't want to spend more than a couple days just hanging around at this level. We see obviously momentum pretty aggressively to the downside. You know, this is a pretty decent support level for an entry, honestly. We see the knife stab down pretty aggressively. We see the histogram cross red below the 0 and flip red here. We see the 821 cross right here, and then we hit 200 exponential and simple perfectly. So there's going to be a lot of people that are still expecting this to stay bullish and buying into it for upside potential. And I think that's probably for now the right play. Now, what changes that? Well, eventually we break down through this. We come down to 236. As soon as we hit the 236, it confirms to me that, you know, there's a likelihood or a high likelihood that the macro top is in, at least for now on this trend. And then what you're looking for is you entered right here. Let's say the trade goes against you immediately from 13 bucks. Let's say you take a long, trade goes against you. Oh no, it's falling. It comes down to 236, and then you hit the 236, find support, and then a lot of people are going to be taking that reversion of the mean play, be buying support with the expectation that we return back to 200 exponential and simple. Now, if we reclaim those levels and go to all-time highs, you got a perfect entry at support. If we come back up to those levels, you know, and now you're flat on your position again, and it starts to get rejected, you know, you get out of the position and then go lower, and then you can buy it at a lower level. That's at least, you know, how I would take that play. So yeah, that was it for the requests. Sorry about those. I had an issue last time with TradingView, so I was unable to do those, so just had to slap them in at the end. Almost forgot them again. Oh, great. Our sex bot is back. Nice. I mean, and why is this bot even on this channel? It's like, let me annoy 6 people. I'm about to ruin these 6 people's night. I'm going to post up all these perv messages talking about whores and sex. Yeah. Oh, yeah. So, yeah, we're going to go ahead and wrap it up there. I'm sure the bots will never stop. Oh, my gosh. There's literally... Man, I forgot about these things. It's been so long since we've been plagued by them. So yeah, go ahead and wrap it up there. Appreciate everybody that tuned in today. Hopefully you guys enjoyed the stream, learned something new. Sorry, I almost forgot about those again. But that is it for today. It is 10 p.m. Eastern Standard Time on 6/15/2022. I am Crypto Trend Trader. Remember, none of this is financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. But yeah, that is it for today. I'm going to go ahead and wrap it up. Make sure you guys are around for our Friday afternoon stream. Well, technically before noon stream, 11 a.m. Eastern Standard Time on Friday. And then, of course, we'll do our Sunday and Wednesday streams every single week from 8 p.m. till roughly 9 or 10 p.m. Eastern Standard Time. But that's it for today. Crypto Trend Trader. Protect that principal. Guard that capital. You know, make intelligent decisions. You know, don't trade with your heart. Trade with your mind. Learn. Sharpen your tools in the bear market, and you will be exponentially grateful for all the things you have learned and done for yourself and for your family in the long run. That's it for today, Crypto Trend Trader, and I'm out of here. Later, Geo Luke. Good to see you, brother. Peace out, guys. Everybody have a great night. Except for the bots. Fuck the bots.